Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Joseph Wang. You may know him as Fed Guy 12 on Twitter. He's a CIO at Monetary Macro and a former senior trader at the New York Fed. Joseph, we're really happy to have you here. Thanks so much for joining us. We've also got Marko and Tracy Shuchart will be joining us during the show. There are some key things we want to talk about. First is a hawkish Fed, of course. We can't talk about that without the Silicon Valley Bank events that happened today. So we'll cover that a bit. We'll get into the systemic risks of quantitative tightening and the likelihood of that happening, as well as America's rudderless energy policy. And we'll talk to Tracy about that in detail. So guys, thanks very much. There's been a lot going on this week. Albert, I know you've been on the road. Joseph, it's your first time here. So I'm really glad we can have this conversation. Guys, let's start out with Silicon Valley Bank. I mean, this is something that just kind of happened yesterday. It actually happened with a communications announcement on Wednesday, coming in the wake of another bank failure. And it was really bad timing. It was really bad advice for them to do this. And we've just seen a bank explode, right? Or implode. So can you help us walk through what actually happened from your perspective?
Yeah, well, first of all, thanks for having me on the show, guys. I love your show, and I do listen to it. So it's a real honor to be here today. So,
Thank you.
Silicon Valley Bank. So, as of recording today, it looks like they've been taken into receivership by the FDIC. So basically, it's bankrupt. Now, Silicon Valley Bank over the past couple of years, if you look at their equity prices, they soared really high, especially during the crypto boom. They were known as a bank that would lend a lot to the financial tech sector. And as the financial tech sector imploded, it seemed like that kind of hurt them as well. These past few days, you saw its stock price steadily decrease. So if you're a bank, you have two big concerns. The one is solvency. Are your assets worth more than your liabilities? And the second is liquidity. Do you have enough cash on hand to meet investor withdrawals? So when I put money in a bank, so I am an investor in that bank, right? So I eventually lent money to local bank, and local bank bought from me, and I can go and get that money back anytime I want. And that is part of the problem of a bank. Your liabilities, they are short term, so they can disappear anytime you want. But your assets tend to be longer dated things like loans, let's say a 5-year or 10-year loan. So I can't really comment on the solvency situation of Silicon Valley Bank. I suspect that they are insolvent simply because I read that they've been making a lot of loans to these fintech companies, and we all know how that turned out. But you can actually get pretty good insight on their liquidity situation by looking at their regulatory filings. If you want to study a bank, and I study banks, so you want to look at something like this.
Great, you're our kind of people, Joseph. That's awesome.
This is a call report. A call report is a financial report that banks file. It's literally a 100-page reporting form, and it comes with instruction manual that's 800 pages in length. So that's why I can actually keep a reference here. So if you look at Silicon Valley's financials, you'll see that it's a bank that is vulnerable to liquidity runs. It might not seem so on the surface, but so just for the audience, Silicon Valley Bank has about $210 billion worth of assets. It's largely funded by deposits. Now, let's look at their asset side first. Now, if you're a bank, you got to keep liquidity on hand, because what if everyone starts to ask for their money back? You want to have some liquidity on hand to meet those redemptions. So Silicon Valley Bank has actually a pretty good portfolio of liquid assets. Of the 210 billion in assets, about 120 billion are securities. Securities are good because you can sell them. That's what a security is. If you have a loan to local company, you can't sell them. That's illiquid. Of the 120 billion, 80 billion are high quality liquid assets. So in the banking world, you want to have high quality liquid assets because you can sell them easily to raise cash. These are treasuries and agency MBS. So far, $80 billion of high quality liquid assets sounds like a great liquid bank. You dig down a little bit more, you find out they've already pledged about 50 billion of those away. So they're already using that to either to secure borrowings. For example, let's say you are a huge investor, you're putting money in Silicon Valley Bank, but you don't really know if you want to take that risk. So you could ask for some collateral. So that could be a possibility as well. So the bottom line is they don't actually have that much liquid assets, even though they look like they do. Now let's look at their liabilities. It doesn't look good either. So normally, if you and I don't know about you guys, but when I put money in a bank, I have less than 250,000, so it's secured by the FDIC. But if you have a lot of money, more than 250,000, then it's not secured by the FDIC. Then you have credit risk. When you look at the depositor profile of Silicon Valley Bank, you can see that they have $150 billion of unsecured deposits. So those are institutional investors who basically lent maybe unsecured, maybe definitely uninsured to Silicon Valley Bank, and they could lose everything if Silicon Valley Bank goes down really badly. They probably won't. They'll get something back, but it's not good to lose money when you put it in the bank. So they have liabilities that are runnable, and they began to run. Now, I've been hearing anecdotally that everyone was like, get your money out of Silicon Valley Bank. So I'm sure they were. Now, if you're a Silicon Valley Bank, that's a huge, huge problem. You have no liquidity. Everyone is asking for their money back. Your last lifeline is to borrow from, let's say, the Fed or a Federal Home Loan Bank. It looks like they're already borrowing from the Federal Home Loan Banks, and I don't know if they can borrow even more. A Federal Home Loan Bank is basically a government-sponsored agency that has whose job is to provide cheap loans to the commercial banks. They're already lending to Silicon Valley Bank. In theory, they could lend more, but they have a lot of exposure to Silicon Valley Bank. So the Federal Reserve Bank of San Francisco, which is the bank that's lending to Silicon Valley Bank, 20% of their loan book is to Silicon Valley Bank. So if you're a CFO there, do you want to increase your exposure to this bank that's probably going bankrupt? So yeah, they're kind of it's over for them, which is why the FDIC swooped in.
So just those are amazing details, and it's exactly what I wanted to hear. Now, what I had read earlier was that there are $171 billion of deposits at Silicon Valley Bank, and 175 billion, but 151 billion of that is uninsured. So basically, $24 billion. People can pull $24 billion out. But there's $151 billion that they may or may not get back, right? So for a lot of these VCs, early stage tech companies, and so on, I don't know if private equity firms or investment funds bank there, but certainly it seems to me to be a systemic risk, especially in the venture capital community. Is that a fair assumption to make?
So I don't think it's systemic to the banking sector, and we can talk about that. But these guys who, in that community, for sure, Tony, I mean, I imagine that a lot of people in that community are banking with Silicon Valley Bank. And if Silicon Valley Bank goes under, they're going to have haircuts. And, maybe it's a lengthy process. Maybe they get tied up in bankruptcy court or something. So that's a liquidity problem for them. And so for that community, yeah, I agree. It could be a big problem.
So if I'm a limited partner at a venture fund today, I'm checking with that venture fund to make sure that my cash is okay. Is that the process that people would be doing? So for people who don't know, limited partners are the investors who put money into a venture capital fund. And my assumption is a venture capital fund would likely store that money in Silicon Valley Bank. And if they can't access they could take the first $250,000 of that, but if they can't get beyond that, then it's not just the VC that's hurt, it's that limited partner. Is that correct?
Yeah. So that losses, like you mentioned, partnership losses flow through from the entity to the partnership. That's what being a partner is about. I imagine there are some rules depending on your general partner, limited partner, things like that. But yeah, it's investors that get hurt. And
so the allocation, both of you guys probably know more about this than I do, but the allocation of, say, venture capital from, say, a pension fund is a relatively small allocation of all of the allocations of, say, a pension fund. So I would suspect that this probably isn't a systemic risk back to, say, pension funds and other investment funds like we had maybe in 2007-8, right? It's probably less of a systemic risk than that was.
Yeah, I totally agree. I don't view this as a systemic risk.
Okay. Great.
Yeah, I agree with that, Tony. I don't think anything systemic is going to happen because SVB Bank goes under. I mean, SVB Bank is the FTX of the fintech banking world. I mean, everything that they invested in is based on trust and not very much of the fundamentals at hand. So it's not a surprise that it went under as the Fed has been raising rates. Everyone knows that as rates rise, the tech sector is the one that gets hit the most. So it's not really a surprise that this happened now.
Yeah, I totally agree. And when the Fed is raising rates, it's trying to slow down the economy through sectors that are interest rate sensitive.
Yeah.
I think the great irony here is that we all expected that to be real estate, right? But real estate is fine. But we miss the fact that the other really interest rate sensitive sectors is tech, and we see big layoffs in tech. So it's actually all the the well-paid people who complain on Twitter who are having a bad problem. But the more blue-collar industries seem to be doing fine.
Right.
Yeah, housing got a boost because there was a lot of cash buyers. People were cashing out, at the behest of Blackstone buying everything, but they were cashing out 3 and 4 times the value of the homes that they had a mortgage on. So they go and buy other homes at pure cash. There's no mortgage risk in the system for the rate. So there's not like, just like you were saying, the housing sector is not really affected by rates at the moment. You can see that because houses are still going up and still a little bit of a shortage, but the tech sector was always the biggest loser of the hawkish Fed.
So one of the things that I hear is that there's the fiscal stimulus from all the construction stuff, it is flowing into the state and local governments, and so that kind of construction spending seems to be supportive of employment, at least in the construction sector. So the guys who, if they're building residential houses, maybe they can go and do something that's benefiting from fiscal stimulus.
Sure. And I can tell you, here in Texas and probably in Florida where Albert lives, there is construction all over the place. It's just, and it's helping the tax base. It's helping the kind of the overall impact of, related jobs and other things. So it is still very strong, at least in the South.
Well, look at the layoffs. It's all been tech and no construction. Construction has a shortage of workers at the moment. That's the best indicator that you can have at the moment.
CI Futures is our subscription platform for global markets and economics. We forecast hundreds of assets across currencies, commodities, equity indices, and economics. We have new forecasts for currencies, commodities, and equity indices every Monday morning. We do new economics forecasts for 50 countries once a month. Within CI Futures, we show you our error rates. So every forecast, every month, we give you the 1 and 3 month error rates for our previous forecasts. We also show you the top correlations and allow you to download charts and data. CI Futures is available for $50 a month, $75 a month, or $99 a month. You can find out more or get a demo on completeintel.com. Thank you. Right. Okay. So in talking about that strength, let's talk about the Fed a little bit. Okay. So if we were talking 2 days ago, there would probably be a bias toward the Fed becoming more hawkish, right? All the buzz 2 days ago was, well, we're going 50, Fed's going to get, be more hawkish, it's going to be tough. But over the last 24 hours, things have really started to lean away from that. So what do you see as drivers of the Fed being hawkish and drivers of the Fed being less so? We can't say that they're dovish, right? But it's more the degree of the, rate rise. So what do you see in the calculus that they're thinking through?
Yeah, so let's level set a little bit. So at the last FOMC conference, Chair Powell basically said that from now on, we're going to do 25 basis points. He said that through his statement. So the language was that rather than talk about the pace of the hikes, we're going to talk about the extent. So that's that would seem like a dumb deal. And from my experience with the Fed, very slow, very conservative organization, 75, 50, 25, 25, 25. You don't go from 25 to 50. Now that's what everyone assumed, and also corroborated by, let's say, President Mester. And then Chair Powell kind of threw that whole thing upside down this past week when he was testifying before the House and Senate. He was basically suggesting that, if the data is still strong, we're going to do 50. And so the market began to price that in. So the question ultimately is data strong? And that has to do with what happened today with the non-farm payrolls and what happens with the CPI report next week. Now, when you're looking at market pricing, like you suggested, Tony, they seem to be taking out that 50 basis point hike today, Friday. And that could be in part because of fear of contagion in the banking sector. I don't know. Now, looking at the non-farm payroll itself, so it looks like the jobs number, over 300,000 was comfortably above Bloomberg expectations of about 200-some thousand. But there was a little bit of a mix in it as well because the unemployment rate increased. I think the pace of a wage increase is also moderated as well. So it seems to be on the stronger side, but not unambiguously so. My perception from this is, if the Chair Powell is basically you pending everyone's expectations and putting 50 on the table, the presumption is 50, and this was not clearly weak. We got to watch CPI next week as well. As long as CPI is not like super, like a big disaster, I think the presumption should be about 50 basis points for the March hike.
So you think the presumption is 50 now?
Yeah, no. So I think today's headline employment was pretty strong. It's not something that is weak enough, I think, to take away the presumption. Again, everything could change with the CPI next week, but we'll see.
Great. Okay. So hi, Tracy, by the way, thank you so much for joining us.
Sorry I'm late, everyone.
Thank you very much. No, that's okay. We know you're busy. So thank you so much. So Joseph, with the jobs data, there were things like, there were 50,000 department store jobs in that jobs data. And to me, that seems like a statistical extrapolation from an old model or something. I mean, I don't know of any department store that's hiring. So when these things come out, what are we supposed to think about that type of data?
Yeah, so a lot of people get into the guts of the report. And the Fed actually internally, they have their own motto for stuff like this. I would be hesitant to be looking in too much into these adjustments, as you mentioned. Now, they matter, but then you can look at every single job report and say, oh, it's actually not as strong as it is, or not as weak as it is for all these little idiosyncratic reasons. I would just take it as it's presented, and knowing a full well, of course, that it is a statistical abstraction of what reality is.
So is it fair to say you see it more as a kind of a direction than something that's more specific? So
yes, and also if you just average this one with the past few ones, it does seem like the labor market, not slowing, has decent momentum, and there could be revisions going forward. I mean, January was revised slightly weaker, so it's just not obvious evidence that data is weak from my reading.
Okay, great. So
Tony,
yes,
I have to. For a long time, I've been saying the Fed should have been doing 50 basis points months ago, but here we are now talking about 50 after doing 25 a few times. I don't think that they're going to do 50. I think more that what they're going to end up doing is talking about QT and doing QT for longer rather than rates at the moment. Just because I think Powell and Yellen and the entire crew over there is a little bit worried about the economy, especially after this bank failed, and looking at the jobs numbers, and I just can't see 20. I just can't see more than 50 at the moment.
That's fair.
It's just yeah.
Look,
I just think that things will start. I just think that things will start breaking if we go 50. We'll be down 200 points on the S&P, and things will start breaking, and you start wandering down to 3,500 on the S&P, and you actually might get a financial crisis.
Isn't that kind of what they like? They kind of want some things to start breaking, right? Like, not that they don't want to bankrupt people, but they do want some things to start breaking.
So
they do, but they keep talking about a soft landing, and that's the plan at the moment.
I agree with Albert. I think the right policy would just be emphasize QT a bit more, but it makes perfect sense. I guess we'll talk about QT in a bit, but it's a good policy from my perspective, because when you do QT, you're putting upward pressure on the rates that actually matter to the economy. You hike the Fed funds up and down, nobody really cares about the overnight rate. When you're talking about economically sensitive rates like mortgage rates or like your auto loan rates, those are like the 5-year, 10-year sector, and that can be influenced by QT. So you want to slow the economy down, you want those rates to go higher. But I think the Fed is pretty stubborn when it comes to QT, in part because they don't really understand. They don't feel like they understand it well. They feel that they understand the overnight rate a bit better.
Okay, so let's talk about that. QT is on our agenda, so let's move to that. So in terms of rates, Joseph, you're in the 50 camp. Albert, you're in the 25 camp. Let's move to QT. We have been undertaking QT for what, 10 months now or something. And it's been gradual. Albert, you smile when I say that. What's your thought?
Well, I mean, we've been doing QT, but then it's been offset by Yellen's TGA activity.
Yep. Yeah. So now what are you hearing about the TGA? Has that slowed down?
It's slowed down now, but once the tax revenue comes in late April, she'll have at it again in May.
Okay. So if we have quantitative tightening, which means the Fed is selling things from their balance sheet into the market, probably at a discounted rate, which takes money out of circulation. And it tightens the money supply, right? But if we have the Treasury issuing funds from the general account, it's offsetting those QT efforts, right?
Yeah, that's exactly what it's doing. And she's actually right now, as we speak, being questioned about the TGA from the House Ways and Means Committee. That's exactly what she's been doing, and I think it's more aligned about why she's doing it politically rather than anything with economic policy in mind.
Okay, so what are the politicians generally asking her about, Albert?
Well, they're asking her about her sterilization of QT by using the TGA and the effects of inflation because of it at the moment. I have a list of the questions that I can definitely give you guys, for afterwards if you want to post them up here. But that's what they're asking her about. Okay. Like, why is her action? Why is she talking about rates when she is a CFO of the country? She is the Treasury Secretary. She's not the Fed chair. She should be talking about rates one day after Powell comes out being hawkish.
Right. It's hard to quit the Fed, I guess. So, okay. So moving on, and generally,
I have a question, Albert. Do you have any views on who might be the next vice chair? I mean, right now the front runner seems to be, Janet Eberly, this academic in Northwestern. But I watched the hearings, and everyone there was like, from the Democratic side, was like, "Oh, we got to have an Hispanic vice chair. We got to have an Hispanic vice chair." And Janet Eberly, maybe she has, distant relatives, or maybe she's going to write a cookbook about tacos or something like that. But she doesn't appear to be Hispanic to me.
Yeah, I mean, I don't know what's that decision is going to be made by Brainerd and Neal, who they want as the vice chair. That goes with their liberal policies and enacting and using the Fed to push those political agendas. That's what they're looking for. I mean, it could be Hispanic or black or white or whoever, but the base case is that they need someone with a liberal slant in their views to help them out.
Yeah, Janet Eberly definitely has a liberal slant. For you guys who are not aware, she thought it was a good idea to have a higher inflation target, and maybe that will be in the future, and not with Jay Powell, but maybe in the future, maybe like a 3%, maybe 4%. Who knows?
I think 3% is definitely coming, no matter what. I don't think it's realistic for us to get back down to 2%, especially with this with the Fed members being far more liberal than they were a few years ago.
Okay, let's talk about the 3-4% rate at some point. But let's get back to QT. Joseph, can you talk us through some of the, if the Fed were to accelerate QT, which seems to be something that you'd like to see them do more of, what forms would that take?
Oh, they could just simply raise the cap for treasuries. So right now, the treasuries can match. So QT pace for treasuries is maximum $60 billion a month. They could raise that. So what happens mechanically is that you can think of it as the private sector having to hold more treasuries. So you're increasing the supply of treasury debt that must be held by the private sector. So basic supply and demand, increasing supply, prices for treasuries decline, and so yields go higher. So that's a way that they could try to tighten policy by making, let's say, longer dated interest rates higher. And I think it's helpful, especially in today's context. So investors look at the world, look at the future based on their experience in the past. And our experience over the past decade was a Fed who would just cut rates at the drop of a hat. And so because the investor community believes that, you have a very, very deeply inverted curve. And that's a big problem because as the Fed is hiking rates on the front end, you don't see that as much in the 10-year. And so you can see, for example, mortgage rates continue to go down as they did in January, thus essentially undoing all the hiking the Fed is doing in the front end. So you really need the market to either believe that the Fed is higher for longer, or you could have the Fed engineer it by just boosting the supply of longer dated treasuries. And it's hard to convince the market of something, and the market is reasonable to believe that Jay Powell and his committee of largely dovish committee is just going to cut rates. So it'd be easier to just boost the supply of treasuries through QT.
Okay,
That's something that nobody talks about is durational liquidity. Nobody speaks about that right now. Especially with the Fed and the Treasury. I haven't seen one analyst talk about durational liquidity.
Okay, so can you guys talk about that? Like, how would they well, first of all, if we focus more on QT, would that potentially pose a threat to, say, banking systems, or are there other potential systemic threats that QT could pose for the US?
Yeah, it could blow up the treasury market.
Okay, tell us how that would happen. Tell us how it would happen.
So I think there's the great systemic risk today is not in the banks or the private sector. It's in the public sector. It's in the treasury market. And we saw kind of a prelude to that with what happened with the gilt market in the Bank of England last year. For those of you who don't remember, last year we saw gilt yields, basically 30-year long-dated gilt yields, basically explode higher late last year, and in part because, one, the Bank of England announced that they're doing quantitative tightening, and also because the government announced that they're going to issue a whole bunch of gilts. Now, there are some levered players in that market who basically blew up. Now, if you recall, throughout late last year, the summer of last year, there's a lot of articles about treasury market liquidity. This is something that I've been writing about since last January. And treasury market liquidity is not really strong, in part because the size of the treasury market is just growing so quickly. It's not growing in proportion to the underlying market. So I think about this as like a stadium that gets bigger and bigger, but the exits don't get any bigger. So 20 years ago, we had about $7 trillion in treasuries outstanding. Today, we got about 25. And Biden is going to promise that he's going to, issue even more through his spending. And the underlying market, liquidity in the market, hasn't scaled in the same way. 20 years ago, we were doing $400 billion a day in cash transactions. Today, it's 600. So again, there's some potential for fragility. Now, the market was looking pretty dicey in the last summer, but it got bailed out when recession fears predominated and people began to think that, Fed is going to cut rates, recession, you got to buy treasuries. But in the event that those recession concerns go away or inflation stays persistent, you can have some real discontinuous event there where yields spike higher like they did in the UK, which of course would lead the Fed to respond. So that's what I view as, I'm not really worried about banking or anything like that. So one thing that people have to be aware of is that the banking system has really changed a lot over this past decade. So an easy way to look at that is just Fed QE, right? So now banks have $3 trillion of basically liquidity from QE on their balance sheet. They didn't have that pre GFC. There's also a lot more regulation now. Banks are really, really, really boring businesses. Back then, it was exciting. Everyone was making huge bonuses and so forth. But now that's on the tech sector. Okay,
so you say that the gilt blow up happened because of long dated yields. Is there anything, if we move into QT, is there anything the treasuries could do? Could they move that to the shorter end of the curve to avoid that?
I think that'd be a great idea. So one of the things that they floated is a buyback operation. So what they would do is they would issue bonds and use that proceeds to buy old bonds. Now, I think it would be a good idea to issue shorter dated bonds and buy longer dated bonds. Like basically change the duration profile. I don't think that's what they want to do. So far, they've been pretty adamant that they want to make it a mixed maturity bond. Now, I'll give you an example. Let's say you issued a 30-year bond, and after 10 years, it rolls down to a 20-year bond. Now, it's an off-the-run bond. So an off-the-run is something that was, issued not recent. And that off-the-run market is very, very illiquid. So what you could do is you could issue a new on-the-run 20-year. On-the-runs are very liquid because they're the recent vintage. You take that money and buy back the old 30-year, which became a 20-year. So you don't really change the duration of the debt outstanding, just the liquidity profile. And that's what they're floating. And maybe that's something they'll do. I suspect that it's not going to be enough. If they want to do something like that, they probably will need to rely, well, it's not going to work. So they're going to have to rely on the Fed, just like in the UK, they relied on the Bank of England.
So isn't in Japan, what they've been doing, particularly kind of 7 to 10 years ago, the Ministry of Finance was issuing shorter duration debt to buy longer duration debt, and the BOJ was buying that shorter duration debt and letting it expire at maturity. Is that something that we could do here, where the Treasury would issue shorter duration debt, the Fed would buy it, they would pay off the longer duration debt, and then it would just go into nowhere?
They could totally change the maturity structure of Treasury debt. It'd be a really good idea. If they did that, they don't actually need the Fed to buy it. There's a ton of demand for cash at the front end in the US financial system. Right now, there's so much demand that people are putting it into the Fed's reverse repo facility, which is about $2 trillion. So that means that the Treasury could issue $2 trillion worth of Treasury bills, and the market would just lap it up like that. So they don't need the Fed to buy it.
Okay, while we're talking about people buying treasuries, I saw some notes over the past week or so where people are saying China is selling their treasuries, everyone needs to worry. Like, can you talk to us about that? Both, Joseph, Albert, can you guys talk to us about that? Like, to me, that seems laughable, but I just...
It is laughable. They need dollars from the reserves to keep them stable. I mean, even if you look at over the long run, I think over the last 5 years, yeah, sure, they had bought a lot of treasuries. Now they're selling a lot of treasuries, but it's pretty even at the moment if you look going back 5 years. So I don't even take that kind of arguments seriously when people say that China's going to sell treasuries and dollars going to crash and blah blah blah. Buy my crypto, buy my gold. It's what it usually is. So I personally don't see it as a big deal. I mean, that's just the way I think about it. So I'm pretty explicit about it.
Joseph, what do you think?
Yeah, it's hard for China to find a substitute for treasuries. So Brad Setzler at the I think the Council of Foreign Relations, he's an expert on this, and he has done some pretty interesting detective work. And one of the things that seems interesting is that the China foreign reserves actually haven't changed all that much over the past several years. So based on their publicly disclosed data, it stayed around, let's say, 3.5 trillion over the past few years. But if you recall, China has been making a lot of money through exports. So during COVID, for example, they were exporting like crazy to the US. Trade deficit with China between US exploded higher, right? So where's all that money going? It's not going to the sovereign fund. It has to be going somewhere else. I think part of it is going to the commercial banks, but I don't really know how their data works out. I think they definitely have a huge problem in that they have a lot of exposure to the U.S. That kind of gives the U.S. political power over them, just like the U.S. could, seize Russia's sovereign reserves. It's a problem for them. I don't know how they can solve it. I'm sure they want to solve it, but so far, it seems like they're stuck, at least for the moment, in treasuries.
It is a big problem for China because when Yellen calls them up and says you got to help us out in inflation and crush commodities, you're going to have to do what Yellen and the Fed say, just because of how much they're held hostage by the U.S. Treasury. I absolutely agree with you on that one.
Let me bring Tracy in here because I don't like it when she's quiet. So Tracy, what do you think about the issue about Chinese selling U.S. Treasuries? Do you see that as an issue from your perspective? Does China have other options? What do you think they're doing with the money they're making on U.S. exports to the U.S.?
Well, I think if we look at the big picture, right? We have seen increased central banks buying of gold and selling US treasuries. But we have to look at the bigger picture. US debt, more people own US debt than any other country in the entire world. So that's not going away. So I hate to cater to these people and say, yeah, central banks are buying a lot of gold, but that means that, you know, they're shutting US, right? Because it's simply not true. You know, you still look at, you know, the highest countries that own US debt still continue to be the same ones, China, Japan, etc. That's not going away anytime soon. It is notable in the fact that looking at the gold market, which has been, you know, particularly lagging, I think it's very interesting if we're looking at the commodity side of things, because we've seen last year, particularly, we saw outflows of gold flows, people investing in gold, whether it's physical ETFs, etc. Literally for, you know, 8 months straight. And so I think that kind of makes this market interesting. But again, I don't want to conflate that with central banks are buying gold, ditching US treasuries, and that means nobody likes US debt anymore. Right. I think that's an important fact that
whenever they sell gold or treasuries, they're just raising dollars. In my opinion, they're just arbitraging for dollars later on. It's nothing systemic that's a threat to the US dollar by any means.
Yeah,
that was my point. It's like, let's not make this a bigger issue than it needs to be, that we've often seen.
Yep, central banks can walk and chew gum and spin plates and all that stuff at the same time. I think it's, you know, they're capable. They're very smart people. They're capable of doing all this stuff. So, okay, just before we move on from QT, Albert, is there anything else on QT that you wanted to bring up that you're watching?
No, I mean, Joseph pretty much talked about it extensively, and there's not really much I can add. I just think that the proper thing for Powell to do right now is to accelerate QT and keep rates as they are at the moment.
Okay, so with housing remaining relatively strong, do you think that they'll sell off more MBS as a part of their QT portfolio, or do you think they'll just keep it in the same proportion that it's been now?
I think they'll just keep it at the same proportion that it is right now. I mean, housing at the moment is a big political problem because homes are unaffordable at 7% mortgage rate, so they're going to have to do something. They're keeping an eye on that. I can guarantee you that.
Yeah, and I also note that Powell has been asked this point blank and just said no. I mean, he can always change his mind. You know, Powell has a reputation for being a pivoter, like he just did. But to Albert's point, you know, like mortgage rates are 7%. I mean, that's kind of already a big drag on housing. If it went to 8%, would that really make that much of a difference? It's already very high.
And you've already seen housing prices come down extensively, right? Redfin just came out and said 45% decrease in luxury homes and 37.5% decrease. So I think what we're seeing is housing prices decrease in response to the increase in mortgage rates, right?
Okay, very good. Okay, let's move on. Since we've been talking about the U.S. government for the first two segments, let's move on to the U.S. government for the third segment and talk about America's rudderless energy policy. So, Tracy, you were tweeting about a speech that Jennifer Granholm, U.S. Energy Secretary, made earlier this week. And I want to kind of parse that through with you because she is the spokesperson for U.S. government's energy policy, and there just seems to be a lot of mixed messages. So, and I've got a tweet on the screen about the Granholm speech where you said, she said we'll still need fossil fuels in 30 to 40 years, then descended into how the Inflation Reduction Act makes the U.S. irresistible for new energy. So can you talk us through kind of what were you thinking of as you heard her, and what were your big takeaways?
Well, the first thing I want to note in that speech is that for the last 2 years, this administration has been pushing on the energy industry, right? And has been talking about how they have all these profits and they're not producing.
Greedy energy companies, greedy,
Right.
just greedy.
That's been the MO, right, for the last 2 years. And then in this speech, she did like a 180 when asked a question. What do you know, how do you think oil and gas companies are responding? She said, we're very happy at how oil and gas companies are responding to our requests for, like, she gave them props, which is literally 180-degree turn from us. So to me, that I was like, what? Because really our production has not really increased at all. But suddenly she's at CERAWeek giving props to the energy companies. And so
Because the CEOs were there.
Well, right. So it's a huge mixed message. The other important thing I think to take away from that particular speech was that the US wants to move on to energy transition. We want to move away from China. We want to be able to mine our own metals and minerals in the US for this energy transition. But she was quick to add that the permitting process is a nightmare in the US, right? It takes 10 years just to get a permit. And then if you get lawsuits on top of that, like, right, this can last, to get to an idea from, I want to, build this mine in the US to actual fruition is a 10-year permitting process. And then plus however many lawsuits you have.
So,
what I thought that was really interesting, in that she actually admitted that the permitting process was completely horrible, since her administration, or the administration that she works for, has said, what we want to do is streamline this permitting process. We're going to give people all of these incentives to build mines, etc. And she basically what she did, if I take away from this speech, is basically what she said was completely opposite of what this administration has been telling us. And that is, it's easy, we have all these incentives, we can build all these mines, it's no problem. And, we love the fact that the US oil and gas companies have responded to us and are producing more, which is outright not true. Sorry.
Okay,
these are political.
Passionate about this.
These are political pipe dreams by the Biden administration. As long as the EPA is there and staffed with environmental Nazis, there's no way that manufacturing and mining is gonna propel to the next level in the United States.
but
it's just simply not going to happen.
Biden budget proposes 17,000 more EPA staff. So,
oh yeah, that's a great sign. That's a great
right.
sign.
But what they're saying, Tracy, tell me if I'm wrong. They've already pushed all this money, or they're already planning to push all this money out into the market. Okay, and this week the EU developed a proposal to kind of complement the US and compete with the US. So there's dump trucks of cash now out there to develop alternative energy. Okay. But both the US and Europe have very restrictive policies on getting those mines together. So on one side of their mouth, they're saying they want alternative energy for a safe future. But the reality is they're paying companies to have Congolese children mine cobalt. I mean, that's the reality of the situation, right?
The reality of the situation is it's not in my backyard, right?
Right.
That's the reality of the situation.
We want cars that plug in, but we don't want people to know that Congolese children are mining cobalt, but that's the crude, stark, horrific reality of these policies today.
Absolutely.
Yeah, if you want an American built iPhone or American built Tesla, from the battery on all the way up, it's going to cost you $5,000 for an iPhone and $190,000 for a little, smallest Tesla you can possibly buy.
And it doesn't matter how many subsidies you give, right? It doesn't matter.
It doesn't matter.
You give, because it's never going to be enough. But it doesn't matter. You think Yellen went to Africa, right? Her trip in Africa, all we heard was she wanted to Africa to join the renewable, generate. That is not why she went. She went to go make deals for for mining in Africa. It's really the
Wow.
back of that situation.
Wow, that's terrible. I mean, it's just the rainbows and unicorns of the policy as it's portrayed versus the reality, the ugly reality of this industry is pretty horrific. So Tracy, as you watched Granholm, what did you think about the oil and gas sector? Did you think, okay, everything's fine, I don't have to worry about, all this restrictive stuff for 5-10 years, they're just going to keep on with status quo?
No, I think once you're looking at the oil and gas sector, and you have to look at what actual oil companies said, right? So you had Scott Sheffield of Pioneer say, there's 5 good years left of the Permian. That's a scary thought, right? And there's no incentive to drill more because the government's telling you that in 10 years, we want you totally phased out. And so we are going to have a serious problem. And I have said repeatedly, I think, that the 13.1 million barrels per day the US produced at the end of 2019 in December is probably the height of, that's it. That's the height of shale, unless something drastically changes within policy. Okay,
so it sounds to me, since there's 5 good years left of the Permian, since the U.S. government wants this phased out in 10 years, there is no ability for oil and gas and mining firms actually to have a capital planning cycle, right? Anything that has longer than a 5-year payback just is not worth investing in. Is that fair to say?
I would say that's fair to say in the United States. Now,
Right.
If we look offshore, which is really interesting, is that's where we're seeing a lot of investment in, say, Guyana or Namibia, or, a lot of offshore sector kind of seems to be the focus right now in other countries because they just don't have the same policy hurdles that the United States does.
Okay.
Yeah, all places where the EPA is not at.
Right.
That's where
Right. So the entire U.S. energy policy and renewables policy is just a big NIMBY policy, like you said, just not in my backyard.
Right.
Right?
It is right now. We'll see what happens. There's a project going on in Alaska right now, which people should be paying attention to. Their policymakers want this to go through. I sincerely doubt that it's going to go through because no majors want to invest up there because they run into a bunch of lawsuits, right? And so why would you knowingly, even if you bought the land rights or the leases, right? It's a horrible place because that you're going to be faced with 1 million lawsuits and give me 1 million hurdles and whatever. And even if you look at the recent GOM auction, right? You have environmentalists suing anybody that's bought leases. So you can't, it's a lose-lose situation if you're really trying to explore more gas in the United States right now.
Okay, so when you say it's a horrible place, do you mean specifically that Alaska's a horrible place? Because I think we have like 3 views there.
Alaska's an amazing place. It's
Okay.
a beautiful place. I have friends from Alaska.
Okay.
But I'm just saying, the problem is that you run into a whole lot of regulatory issues, and then you run into a whole lot of lawsuits that are going to take place. And really, that's a whole separate issue. And I really wrote about this in 2020, was the land that they auctioned off is part of a reserve.
That's always a good idea.
It probably should have never been, right? And that's why it really got no interest. It did get a bid from Chevron again, but I don't see that project going forward ever. So
okay. Yeah, it's crazy. And as I try to figure out policy, and I talk to you and I talk to other people, I just can't figure out what we're going to look like in 5 years. And if I was in charge of CapEx budgets with upstream, downstream, midstream, I honestly wouldn't know what to do, because
that's why we continue to look at these companies, continue to focus on dividends,
Yep.
capital discipline, and paying down debts. I mean, you have to remember
Yep.
these companies were not making money for years. Their
Right.
debt
So that's
was-
an important point. So when the president of the United States says that Chevron is a terrible company for giving large dividends and doing large share buybacks, they're doing that because they cannot spend that money on CapEx because they don't know what the environment is going to be like in 5 or 10 years. Is that correct?
Yes, exactly. And that's the point. And they're trying to gain shareholders. I mean, you have to look, a decade or 2 decades ago, we had the oil and gas sector was 20% of the S&P 500 weighting wise, right? And at the lowest in 2020, we were a little bit below 2%. We're now at about 4%, but you can see where, that market has fared fairly poorly.
Yeah, but Tracy, it's all going to be AI software,
Yes.
going forward. So just, complete
I mean,
intelligence.
it's
You
gonna
guys
be
should all be-
Chevron dot.
Yeah.
Chevron's
Yeah.
gonna
All
change.
A-
It's gonna be Chevron dot AI.
Yeah, all funded by a new Silicon Valley bank.
Yep,
We'll go with
that's
that.
right. Okay, guys, we have a big week ahead leading up to the Fed meeting. So what are you all expecting? Joseph, what do you expect to see next week with the various prints coming out?
It's all about the CPI. I mean, I want to know if it's actually strong. If it's strong, then we got 50 basis points locked in. Right now, like you mentioned, Tony, that's been taken out of the market. It could be a violent repricing. So that's what we want to focus. So I'm suspecting that we have a lot of people are pricing in rate cuts in part because of what they perceive to be some risk in the banking sector. I just don't see that. And so when we see that come out of the market, we could have rates go back to expecting a more higher for longer stance by the Fed.
Okay, great. What is a high CPI to you?
Well, whatever. I haven't checked the expectations yet, but whatever is higher than expectations.
Okay, so it literally higher than expectations. If it's higher than the consensus, then that's a high CPI.
Yeah. So I mean, so if you think back a couple months, we were seeing CPI go down, right? This deceleration. I want to know if it really just did re-accelerate, or if it just kind of gave back what the increase from last month. Okay,
great. That's perfect. Albert, what are you looking for next week?
Same thing. CPI is make or break for this Fed on 25 versus 50. I'm hoping somehow they've managed to manipulate the CPI number to make it somewhat in line with the consensus. Hoping for a nothing burger would probably be the best option at the moment. Something meeting consensus. If core CPI is hot, like Joseph said, 50 is locked in.
And if super core CPI is hot, that just reinforces wage expectations, and it's all this circular situation, right? So okay, so if we do see a 50, do you see an impact on equities, like a negative impact on equities? Do you think it'd be sideways? What do you
Without
think
a doubt. Without a doubt. I think if they go out and do 50, I think we're down 200 points in the S&P pretty quickly in the week. If they do 25, we might even rally 100 points. You know how it is. We're in Bitcoin world now in the S&P. So.
Right. Exactly. Okay, that's good to know. Tracy, we've seen oil kind of move sideways. We've seen energy kind of move sideways lately. What's happening, and what do you expect to see?
You know what? I think we talked about this the other week. I continue to think it'll move sideways. I think we're in a range OPEC is very comfortable with, that $80 to $90 range for Brent crude oil. And so I see no reason for much to change in that. I think, as we head into high demand season, right? June, July, August, we could see an uptick in prices, but for right now, the market is very comfortable.
Okay. And then this Saudi-Iran peace agreement that was announced today, do you think that has an impact on crude supply? Do you think that could push crude prices down?
I don't think that, no, because OPEC has existed for a very long time. Iran is an original member of OPEC.
Yeah, they were the founding member, right?
So, that relationship has existed cohesively beyond any of the other geopolitical problems that they have had. And, Saudi Arabia has always said that this relationship will exist beyond whatever other problems we're having. So I don't think within the oil market, it really changes any dynamic because that relationship was already solid.
That's good to know. Okay, guys, thank you so much. Thanks for your time. Thanks for all your knowledge. Have a great weekend and have a great weekend. Thank you.
Thanks, Tony.
Bye, guys.